DOGE cuts are affecting everything, even housing. Hi, I'm Danny Brown, CEO of Myriad Real Estate Group, and this is going to be our March market update. So we are fully in the throes of the spring selling season here in Greater Phoenix. Typically that runs through about mid-January and ends in roughly June when our triple-digit temperatures hit and everybody leaves Phoenix. Kids out of school, people take vacations, and so we see a dip in the market once we get to that June timeframe. What we are seeing is a lot of people interested in selling their homes, so we're seeing a lot of homes come to market, but what we're not seeing is that increase in buyer demand. So a lot of people tend to overcomplicate the housing market when it really just comes down to simple supply-demand economics. When you see an increase in supply, but demand remains low or flat, what do we see? We see a softening in the market. So we haven't seen home values start to lose value yet, but if this trend continues, it is certainly a possibility that we will start to see home values come down. Well, it all echoes back to the things that we've been saying now for several years, is that interest rates remain high. So up until recently, we saw interest rates hovering just above or around 7%. This last week, or the last week of February, we saw a lot of soft economic news. So a lot of confidence has come down, consumer confidence. We've seen the unemployment rate start to tick up a little bit, and we're just seeing cracks in the economy. And that has started to decrease the 10-year Treasury and has brought that down off its highs. And as that decreases, we see a decrease in mortgage rates. So right now, the 30-year fixed for FHA is hovering around 6.25%, which is great. 30-year fixed for conventional is hovering in kind of the mid to high sixes. So if we continue to see softness in the economy, we'll continue to see the 10-year come down, and that will continue to bring down interest rates. Now, looking at the past or historical data, we start to see the housing market become unstalled when interest rates get to that 6% range. And so hopefully, and I've been saying this for a long time, hopefully we will get there and we'll stay there with some duration where buyers will come off the sidelines and start to purchase homes, and we'll start to see an evening out in the local housing market. So the softening in the economy is multifactored. We are fully into the Trump presidency, and we are starting to see his economic plan take shape, and that is causing consumer confidence to fall. We're also seeing a lot of mass firings in the federal government due to DOGE. So the largest employer in the country is the federal government. And so when you start doing mass firings within the largest employer, naturally you should start to see an increase in the unemployment rate. So I think some of this is absolutely orchestrated. I think that the Trump administration knows that in order to get the 10-year to come down, to make the cost of borrowing cheaper, they need to increase the unemployment rate. How do you increase the unemployment rate without affecting the private sector and businesses and small businesses and essentially pushing us into a recession? Well, you do mass firings at the largest employer in the country. So I think that's part of their ultimate plan, is to try to get the unemployment rate to come up through firing of a lot of federal employees. And it looks like, at least in the early numbers, that that is starting to work because of the softening in the economy and the drop in the 10-year Treasury. So I think we are a far cry from mortgage rates getting into the mid to high fives. But again, if this trend continues, if we continue to see softening in the economy, interest rates certainly will get to that 6% range. I'm hopeful that that is the case. A byproduct of all of this volatility and uncertainty in the market, mortgage rates coming down, increasing the affordability of housing, and really having buyers return to the market. What's really interesting to me is we're seeing an increase in seller activity. Most sellers become buyers. So I do think that there is a lot of buyers, people who want to purchase homes, but they have to sell the home they're in order to make that move. So it's kind of this domino effect. If we don't have those entry-level buyers buying those homes, allowing those people to sell to buy the next home and leg up, it's creating this stalled effect. What's also interesting is a lot of these people are not forced sellers. So we're seeing the largest number of delistings that we've seen in some time. So that means that sellers are putting their home on the market, trying to get a number that makes sense for them to move on to the next stage. If they don't get that number, then they're just pulling their home from the market. So a lot of these people do not have to sell, they just want to. And so they're testing it. And if they don't get what they want, they just pull it from the market. So we're seeing a lot of that as well. So if you're a buyer in this market, that is great because it is soft and you can absolutely negotiate with sellers, right? I am a big fan of paying closer to what the property is worth and then negotiating closing costs and getting repairs done in lieu of coming down on the purchase price. If you're borrowing funds in order to purchase that property, once you amortize that over 15 or 30 years, you know, the difference of $10,000, $15,000, $20,000 is not very much on a monthly basis. But if you can get the seller to contribute towards your closing costs, you know, somewhere between 2 to 3% of the purchase, if you can get them to replace air conditioners and roofs, that is real money in your pocket. So I'd rather pay, you know, a couple $100s more per month to save tens of thousands of dollars through closing costs and repairs done to a home. So be very strategic on your offers and how you're approaching these sellers. It's also a lot easier to get a seller to do things for you once you're under contract and they've emotionally checked out of the house, right? They've accepted an offer, they're thinking about what they're going to do next. Now you come at them with an ask for, you know, repairs or credits in lieu of repairs. They're much more willing to do that once you have an accepted contract and they've emotionally detached from the home. If you're a seller in this market, well, expect longer days on market. It's taking longer for homes to sell. Expect increased competition, and you absolutely need to price the home correctly. I've had a lot of conversations with sellers, specifically older sellers, that no one negotiates much anymore. The average sales price to the final list price is about 98%. So what does that tell me? That people are fine with paying very close to the list price of the home. They don't do a ton of negotiating. So the old adage to list high so you can negotiate down doesn't really exist. And if you think about to other markets, and I've been using the car market, for example, how often do you do negotiating for a car anymore? Usually you're walking in and you're paying sticker price or MSRP. There's companies, CarMax, Carvana, all these companies exist to get rid of the negotiating. And so that is an art that is slowly disappearing. And so a lot of times if a buyer is looking at your home and they see that it's overpriced, remember they have more access to information than they've ever had before, they just bypass you altogether. They're not just gonna make an offer. That doesn't really happen that much anymore. And so you've really got to be strategic in your pricing, be aggressive, price it right early, and if you're not getting the traction and the showings that you want, then you got to start doing price drops. And I'm sorry, doing something like $5,000 to $10,000 is not enough usually to move the needle. You've got to do something a little bit bigger than that in order to encourage people to come see your home and make that offer. Thank you so much for tuning into our March market update. If you have any questions, leave them below. Don't forget to give a like and subscribe, and I will see you next month.